Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Halftime Report, 12 noon, halfway through the trading session. I am Reema Tendulkar and with me is Nigel D'Souza. Well, it's all about ICICI Bank, right? That's the one which is pulling up at the index level. So while the Nifty is higher by, 27 points, the last time I checked, about 23 points is courtesy ICICI Bank. Let's get the intraday chart up for you on your screen. ICICI Bank with a 4% up move today is clearly calling the shots, at least at the index. We get to the pharma major Cipla Q1 numbers were a bit subdued at the revenue front. The key highlight for the quarter was the margin improvement on a quarter-on-quarter basis. CNBC TV 18's Archana Shukla caught up with the management and began by asking them about the margin pressures in this quarter and whether they continue seeing it going forward.
I think our biggest pressures have been commodity price increases that are happening around the world. We've seen them in China, coming out of China. We've seen fuel prices going up as a result of that, and industry responds to fuel price increases as well. So we've seen this. There is limited pricing power across the world now for pharmaceuticals. You know, we've seen actions in India around pricing. We've seen actions in the rest of the world. We are also not immune to US pressures, though we have a much lower base. We don't get hit as much, but we have those pressures as well. So we're seeing price deflation across our markets. We're seeing commodity price increases. And considering that, I think we managed to a very good outcome. We are actually pleased. We are ahead of our internal estimates on where we've reached. But Kedar, do you want to add some specifics?
No, I think that's fair. I think this was in line, in fact, a little bit better than what we thought we would end up with.
Yeah, because it's not so much in line with what the market was estimating. Market was estimating you to do slightly better than this.
Yeah, but sequentially we increased margins by more than 300 basis points. Currency came to the rescue. Mix of businesses has been good. So API did well this time. RX business in India grew by more than 22%. So all of that came handy. Costs have been in control. And going forward, what's going to happen, a little bit forward outlook, as the mix of limited competition contribution improves in our US business, that will come handy as well.
But because these pricing pressures are going to continue to stay for some more time, so how are you looking at margin, let's say, in the next few quarters and for this fiscal?
What I would think, so a couple of factors will play. In the first quarter, the impact of currency on the import cost did not play out as well because we consumed stocks out of the opening inventories. So that will be adverse going forward. In the revenues, currency will come to the rescue. That is one. But as the contribution from the limited competition launches in US improves, that will, improve the margins. So
it will stay at around 18-19%, or you're hoping to cross 20% in this fiscal?
Well, typically quarter 2, quarter 3 for us are better quarters. Quarter 4 is usually a worse quarter because of the season effect and, of the businesses worldwide. So we're hoping to be higher than where we were in quarter 1. Now, exactly, we don't guide to numbers, but we had given a guidance at the beginning of the year that we will improve our margins. So I think we're on that track. We're hopeful. We're hopeful of where we end up.
US has certainly been the pain point, flat growth, lots of pricing pressure as well. How does the trajectory look like, and what, apart from pricing, are there other efforts that you're using in the US market?
See, US as a market, there are two things that we look at. The first is we had our own issues, right? We had our own issues of supply which have lasted us beyond a quarter, but now they're behind us, thankfully. So I think that's one result why our quarter-to-quarter movement has not moved up. The second issue, which is also important, is that the US deflates at about 10%. So we have shown a flat growth, considering the deflation in the market, considering our own issues in terms of capacity and supply. But I think, I think the subsequent quarter should be bigger for us in the US.
Okay. And what is going to kind of drive that, growth in the US market for you?
See, what we track is the ratio of launches which we have made in the last 12 months. How much of those have contributed in the current quarter? That ratio is improving for us. So in this quarter, whatever products we have launched in the last 12 months, they contributed 30%. And that's growing. And all of those are high margin.
And you've also rationalized a couple of your product portfolios in the US market, which has some sort of an impact on the numbers. Could you?
Yeah, so when we rationalized it, what's happened is that it's not in the numbers anymore. right? And we've rationalized it because there's no point producing it, because we can show the sales, but it doesn't bring us enough profit. So I think all of this has come together for us, and you know, we are happy that many people are showing US decline in numbers, right? We are happy that we're at least flat, right? And now we're hoping that we get to growth. So hopefully, you know, this quarter, the next quarter, we should begin to see growth.
Coming to India, Kedar, you know, good performance of this quarter. What really is driving the growth here in India is, you know, the focus on in-licensed products kind of adding more value?
There are multiple things which we're trying in India. India is a growth driver for us. It's our home market. You know, be it therapy shaping initiatives to improve awareness on respiratory, be it these in-license launches that you referred to. There are several things that we are trying, and all of that is contributing to sales. In terms of in June or early July, I think the season is not yet picked up, so we could have done actually more than what we did. But yes, the generics business delivered very strongly. Prescription business could have done well. In totality about 22%, and you have to remember last year numbers includes excise. This year GST is completely excluded, so actual in-market growth is higher than what we have reported.
Okay, just before I let you go, where do you see FY19 to be ending for Cipla in terms of revenues and margins?
So we've spoken thematically, so we have not given guidance in terms of numbers, but margin improvement remains our priority. We've spoken about $1 billion revenues for our Indian market. We said US certainly has to be healthy, high-digit growth. So that's on the market side. We said filings will continue with 20 focused filings in US, and all that's on track.
Oh, just keep an eye out on a couple of these stocks in the broader market. JP Associates, in the last few minutes, that stock has seen a sharp downtick. It's moved to the low point of the day, so just keep an eye out on that stock. Suddenly, some big selling is what we're seeing on that counter. Well, on that note, I'll tell you what, we'll slip into a short break. You come back, we'll get chatting with the management of 20 Microns. Remember, they posted a very good set of numbers in yesterday's trade. The next stock on our radar, they posted a good set of numbers in yesterday's trading session. The sales were up by more than 10%. We had the net profitability that close to have doubled this time around. We have Atul Parekh, the managing director of the company, who joins us on the phone line. Hi, Atul. Thanks so much for joining in. Well, it's been a good start to the year. If you could tell us, you know, from the specialty business, you were telling us that you're going to be increasing your focus there. How is that shaping up? What is it as a percentage of the total revenues? And also tell us for the remainder of this year, should we be working with double digit? Can you do better than this?
Yeah, this is, it's been definitely a good year now. And as you can see, the results have been very positive. And we definitely look ahead in the year with the same numbers on double-digit growth that we see in the top line. And definitely in the bottom line, we see the EBITDA margins increase by 50 to 100 basis points. And the PAT also kind of being in the same range that you see in the Q1 results. With the specialty products, it contributes about 20 to 22% of our total turnover as of now. And the 20 Microns now is going on with a semi-IPO for its subsidiary, where it will be focusing more on the value-added minerals and specialty chemicals that it is currently doing, which we have already filed the DRHP with the SME exchange, and we should come out with the IPO anytime in the next few weeks.
130 crores is what you can do in terms of sales for this year. Last year did 390.
Right. We will be going with about 11 to 15% growth in this year for the same. Yeah.
Okay. You said the specialty chemicals currently contributes about 20 to 22% of your overall revenues.
Right.
If you could throw some more color, what are the kind of margins you enjoy? What was the growth particularly for your specialties business, and how much can it contribute going ahead, say by the end of FY19?
Well, we are currently trying to reclassify all the products in our portfolio. And we are more focused now on the specialty chemicals business. And that is the reason I mentioned that we are trying to create a new subsidiary and going on for an IPO for putting up a new plant in Baroda. And for that, we see that the products have a very good margin. The EBITDA margins are really good in double digits. And we expect that that would continue to grow because all our customers currently are importing these particular products, and we are substituting those import products with domestic manufacturing.
Okay, you're saying you're going to go in for an IPO of one of your subsidiaries. What kind of money you'll raise from there? And what about the debt in your books? I'm looking at your finance costs. That's come in lower on a year-on-year basis. So have you repaid some debt? What is the debt in your books, and what cost are you borrowing at?
Right. So, yes, we are going in for an IPO for a size of 21 crores, which will be raising mainly for the CapEx, for setting up a new plant here in Baroda. And it will be mainly focused on the specialty chemicals that we're the high-value products with high-margin products. And yes, we have debt on our books, which we have started repaying through the internal accruals. And we, in the next 2 to 3 years, we intend to kind of eliminate the debt component that we have on the books through the internal cash accruals.
Okay. You do not plan to, pare down your debt by means of any idle assets? Does the company have any idle assets which it can monetize?
Yeah. No, as of now, we do not have any idle assets. All the idle assets that we have already been planned to be converted into manufacturing in the near future.
Okay, all right. Atul, final question. I remember the last time you joined us, earlier the promoters were selling stake and obviously your investors would not be too happy. Is there a possibility, now it's been rather constant, is there a possibility that you go ahead and increase stake? Because you had hinted last time around.
Yes, it was more of a reclassification that happened earlier, and in the promoter group for the shares. And we have done in the Q1 of this year, we have done creeping acquisition of about 0.4% by the promoters, and we intend to keep continuing to do that under the limits. And we tend to increase the promoter shareholding in the near future for sure.
Okay, Mr. Parekh, we'll leave it at that. Thank you very much for joining in. In fact, let's get back to the JP Group story where the Supreme Court has ordered fresh bids for JP Infra. They've disallowed the JP Group from participating in the resolution process, and the Committee of Creditors will be reconstituted. And as per the recent amendments to the IBC, the home buyers too will be a part of this resolution process. Our colleague Lata Venkatesh is also here to take this discussion forward with Sumant Batra.
Yes, Sumant Batra, a leading lawyer and in a way one of the fathers of the Insolvency and Bankruptcy Code itself, is joining us. Sumant, just a word for our viewers. Today, the Supreme Court did a couple of important things. It has said that the JP case shall proceed in the NCLT. That is where it should be decided and not in the Supreme Court. That was one judgment. The other one it said is that people with NPAs cannot participate, so JP is excluded. In a way, it kind of reiterated faithfulness to the process set up by the IBC. Now you tell us, Sumant, what were your key takeaways? What will be the impact of this case on generally home buyers?
Sure, Lata. I think the order is quite on the lines that we were hoping that it would be, that the court would eventually refer it back to the NCLT and to run the process in accordance with the IBC. The only thing which has surprised us a bit is that the court has chosen to reverse the clock from the starting point and said that you will have 180 plus 90 days if required, which means that you have to really go back to the time from where you started. So that might create a bit of an anxiety for the home buyers because they were hoping for an expeditious resolution of the whole process, and the general thinking was that court would probably give about 30 to 45 days to complete the process by obviously reconstituting the COC with home buyers in, and also giving opportunity to the resolution applicants who had already thrown their hat in the ring. So to that extent, it is a surprise. But otherwise, I believe that from the home buyers' point of view, it is obviously very satisfying because now they would drive the process. Okay.
Well, there's another point of view which is emerging from some people who are close to the home buyers, not the least our own real estate editor, Manisha Natarajan. She says she's spoken to a cross-section of home buyers, and it is very difficult to make them believe that they cannot expect their entire money back plus 18% return on the money locked in for that time. Now, if you cannot make them agree to anything less, if you can't make them agree to a haircut, it's quite possible that the COC doesn't find the whole thing viable. Do you think there is a very big danger in cases like this that it goes into liquidation?
I would not call it as a danger, Lata, but certainly a risk and a high risk. But I am hoping that the insolvency professionals who would represent the home buyers and he would eventually be on the Committee of Creditors would sensitize the home buyers and make them appreciate the reality of the life, that in the insolvency process there is every likelihood that you would never really get your entire money back. So they would probably opt in favor of the flats being constructed as soon as possible rather than asking for their refunds. So now that is the hope, but I shouldn't really be saying more than that because I'm going to be advising the RP. So I don't want to prejudge or predetermine.
No, you don't want to prejudge, I agree. But it is a logistical nightmare to get permission. I mean, in Amrapali's case, it is 35,000 crore. I mean, 35,000 people. I'll come to the Amrapali issue in a minute. But it is just, is it possible for a hypothetical RP to be able to convince a hypothetical list of 35,000 home buyers?
I understand, and we are already quite concerned. I and Anuj have had a few discussions on this, and we are looking forward to this new challenge. JP was any which way so complex, but we brought it to this level. But now, obviously, we are preparing ourselves to meet this new wave of challenge. Which is this time going to be combined not with legalities only, but also with the emotions, because the emotions are going to be so high in the COC now when we sit and deal with these people.
Okay, one more allied question. Is it possible that, quoting this precedent, the bankers also take Amrapali back to the court and say that why should you have an NBCC intervening at all? This is our money. A precedent has been set in the JP case. Should not Amrapali also be decided in the NCLT? And after all, they had two bidders.
I think that's a high probability, and depending on what the other part of the order of the bench that pronounced the order today in JP is, because we only heard the operating part, so we do not know what the remaining part of the order is. Depending on what is said there is every possibility that Amrapali also might just get relegated to the NCLT. But obviously, I can't comment beyond that because I'm not involved.
Fair point. No, I mean, I'm asking you more as a legal expert. What happens now to JP Associates? It was in RBI's second list and had to be taken to the NCLT because it checked certain boxes, NPA for 6 quarters and, NPA since March 2016, etc., over 5,000 crores. It checked all those boxes, and so it had to be taken. Now, what happens to the deals struck by JP Associates in terms of the sale of assets? Does not the IBC code say that all sale of assets happened in the previous 1 year of a case being taken to NCLT could be cancelled or at least reviewed? So,
Lata, the only change that has or would probably happen is that the battleground would shift from Supreme Court to the NCLT. Nothing else would change. GAL would still agitate, and so would its lenders, that you need to take a fair call whether insolvency is the most feasible solution or... No, that is JAL. I'm asking you about JPA. When JPA goes to NCLT, as the Supreme Court has sent it, is it not possible that all those deals with Ultratech and, some big deals were done? I believe that anything that has been completed in 1 year of 1 year prior to going to NCLT can be reviewed? Well, yes, they can be reviewed, but you will appreciate that in the insolvency, you have to run the enterprise as a going concern. So if there is anything that needs to be honored, can be honored. That's a commercial call which the RP will now have to take. What is it? It is in the best interest of the enterprise going forward. It doesn't mean that everything decision that has been taken, unless it's a fraudulent decision or a preferential or a wrongful business decision, can be reviewed. So it's now for the resolution professional in those cases, together with the lenders, to take a call as to what would be in the best interest of the enterprise going forward in terms of achieving a successful resolution for it.
All right. Well, but net, to come back to the point where we began, for the IBC process, today would be a good day.
I would say so. At the end of the day, I think this is a very strong and powerful message that goes out. Because that is what the government also argued, that, 142, yes, we all respect the powers of the Honorable Supreme Court, but when it comes to maintaining the sanctity of the process under the IBC, we do expect that the NCLT needs to be empowered and to be given an opportunity to explore the process through the 270 days. All
right. Thank you very much, Sumant Batra, for joining us and giving us the benefit of your observations. Okay, well, there you are. Home buyers have to vote with maturity. They are 60% of the creditors. But how do you get 10,000 people to agree? And many people would say, you're not learned in the law. All you think is that, we have to get an 18% return. When we don't pay our EMI on time or our share of our payment to, a home buyer. He charges us 18%. Now I should get my money with 18% interest. To make 10,000 people understand that even if you get your home, it's a big thing, could be a little difficult. So we are striking fresh ground over here, and one hopes that the JP case, kind of shows the way on how to deal with this with maturity. Separately, JP Associates investors should now worry about how the NCLT process goes for them.
All right, Lata, thank you very much for that. But a lot of mid-cap earnings have been coming by. So let's talk about Bajaj Electrical. The revenues are not strictly comparable on account of the excise impact on the top line. But margins have come in lower at 7% versus 8.4%. There is an exceptional loss which took place in the prior quarter. So if you look at the profit before the exceptional item, it's actually halved on a year-on-year basis. It's at 62 crore versus 133 crore, which is why the bottom line too is so that's about Bajaj Electrical. The profit before exceptional is actually lower. That's the reason why there was initially a positive reaction on the stock, but now it slipped from the top of the day. Margins are weaker, and it is an exceptional which has boosted the company's profitability. Focus on the stock of the day, and that is ICICI Bank, now higher by nearly 4.5%. A lot of optimistic brokerage comments have come through from the likes of Morgan Stanley as well as Credit Suisse. Abhishek Kothari joins in with a complete roundup. Abhishek?
To begin with, analysts have given a thumbs up to the outlook from the new management that they have got, and the risk reward in terms of valuations are very attractive as it offers a higher margin of safety is what the brokerages are saying. Now, Morgan Stanley has an overweight rating on the stock. They have increased the target price to 460 from 425 earlier. They believe that in the next 2 years, this stock can be a doubler due to impaired loans getting normalized and the bank returning back to growth. They believe that the next 2-3 quarters may be volatile, and after that they believe that the risk reward is really favorable and margin of safety is high because the valuations are just 1.2 in terms of price to book value on FY20 basis. Credit Suisse has an outperformance rating. They believe that the CEO has mentioned that the corporate asset quality cycle, the worst is behind them. Most of the provisioning cycle will be taken care in FY19, and bank is well poised to expand its market share and grow the book. They are willing to continue investing as well in the headcounts, which is another positive trigger. And with credit cost normalizing, Credit Suisse believes that the ROE, that is return on equity, can recover to 13% by FY20. Back to you.
Okay, all right. Thanks so much for that, Abhishek. Well, by the way, I think we have a couple of numbers that have come up. I think we should get Sarah Santriba has come out with that set of numbers. Just first look at it. It appears that on the top line, the growth is quite healthy. I think they've given a growth of close to on 20%, I think, on the top line. So I think we should get those numbers up. They're just getting uploaded on the, the exchanges. But, initial reaction that we have is the profitability is more or less flattish. So we'll have to see what exactly was the margin performance as well. We'll keep an eye out. Yeah, there we have it for you on the screen. There's a 20% growth on the top line, but and the net profit is as flat as can be, despite the fact you have a top line such a big growth. So I guess there could be some margin compression. Our ticker team will be getting those numbers up for you on the screen very, very shortly. Net profit number a little flattish. But let's get in some market opinion then. Earlier today, we spoke to Nilesh Shah of Envision Capital. He says that global growth remains the biggest risk to the markets, adds that there could be some pain for the next 2 to around 3 quarters in corporate banks.
I still think that the retail participation has kind of come down significantly. Global investors continue to be cautious on emerging markets, including India. And I think that some of the global headwinds will kind of resurface sometime towards the end of this year. So I think keeping that in mind, you're still going to see this market behaving in a pretty narrow way, pretty much like what it has been for the last 4 to 6 months. I think the biggest risk right now is global. Somewhere down the line, I think the global markets are kind of showing some bit of calmness, which I think can probably end up being a bit unnerving at some point of time. We've seen the corporate banks continuously say for almost now 3 years, and every quarter they come up and saying that the worst is over, and by and large everything seems to have factored in, but every quarter you kind of end up seeing that the slippages continue. Overall, I still think that there could be pain for maybe another 2 or 3 quarters or so. I think the insurance space looks the most attractive right now at this stage, and that's purely because of, the reality is that India is highly underinsured, we are underprotected, so to say, and clearly, if I were to kind of look at the next 5 to 10 years, I mean, this as a sector could be probably 5 to 10 times of what it is today. We think that cement looks to be a good contrarian bet right now. We believe that the housing activity is going to pick up further momentum. Infrastructure construction is going to kind of do a lot more a year later. And it's quite possible that private capex will probably start picking up a year down the line. And we think that probably cement is the best proxy for all of this.